Hey everybody, and welcome back to another video. This is How to Invest. Spencer here, and this one's going to be another much needed update on GrowGeneration stock. It was absolutely hammered again today, down over 6.5%, but it's not alone. Basically every single stock in the cannabis sector today was down tremendously. Tilray was down 11.5%, Aurora Cannabis was down 11%, and Canopy Growth Company was down, or Canopy Growth Corporation was down 9%, which is all just terrible. Anytime a stock is down that bad, there is a crazy amount of selling pressure. And this was basically all due to like a false sense of hope for legislation of nationwide decriminalization. But a lot of this was broken down. If we look at the 5-day on a lot of these charts, I think it came about really on Friday. There was like a good push in a lot of these stocks. If we go back to the month, even really around the 11th on a lot of these charts, there was a good amount of bullishness, and they kind of took off right around all that date. And then they've been straight down ever since really these talks have broken down, and that there's been almost confirmation that this really has no chance of happening and wouldn't really affect anything. I just want to make this video because I still think that GrowGeneration stock is still very undervalued. And there was an article that came out just a couple days ago before this huge move downward. And we have had some consolidation today where people are starting to buy the stock and put buying pressure on it and start to try and move the stock back up, because right around that $20 range is anytime you get to a multiple of 10, people like to think of arbitrary numbers as walls, even if they're not. So it's typically an important range because we did really hang around that $20 price per share level today. But if we get into the article, to start, it is titled, "Here's Why We Think GrowGeneration is Well Worth Watching." So he just goes on to say in the beginning that most people typically like to go for stocks that don't earn money and more are narrative-based and sexy. And it's easy to lose money in pump and dumps in these schemes. And I've definitely fallen victim to this too as a new investor quite a bit ago. But you can make money in these too if you sell out very, very quickly. So they're not always too bad if you know what you're doing. But you obviously don't want to be involved in the pump and dump because that could be just involved in legal trouble too. But they go on to say that he likes old-fashioned companies that are profitable and make a lot of money, which is something that we have in common. This is one of the themes that I like to really preach on this channel, is just that the whole point of investing is to get a return on your capital, and for the company that you're investing on is to make more money from the money that you're investing on. And that is good because this company does make quite a substantial amount of money for just how early and new of a company that they are. They are just in a very, very young field and industry in the cannabis sector and have really ways to grow. And it's just going to be amazing to see over time. They go on to say that their EPS has grown from 0.06, which is 6 cents, almost 7 cents, all the way up to 30, 31. So over a 4x, almost a 5x in a year, which is phenomenal. And they say that EPS is typically what does drive shares upwards, because it's earnings, like I said earlier, profits, what move a stock. People like companies that make money, and the more money you make, the better, as long as your shares aren't too diluted and you don't have trillions and trillions of shares. That would be bad. But it goes on to say they took a look at their EBIT. Typically, people like to look at EBITDA numbers when you're looking at quarterly results or even year-long results. But their past quarterly result wasn't too phenomenal. So I think he's just trying to finger pick some data points that did look really good from their past quarter result, which I think they reported on the 11th or the 15th, one of those 2 dates. But their EBIT grew from 3% to 6%, and their revenue is still growing. So he says ticking 2 boxes is a good sign of growth in my book. And then here is a look at the revenue chart over time. And they also have the earnings, the free cash flow, cash from operating, and operating expenses. So their operating expenses are growing, but this company is growing substantially. Their really business model is trying to build out as many of these superstores that they have as quickly as possible, and acquire as many brands locally in each and every state. That makes it easily to run these businesses, because it takes a lot to run these superstores. So they have to acquire a good amount of businesses to do this in each and every state, which is why they have so much cash on their balance sheet, which is what one thing that we'll get into the article a bit later. The next really article or point of the article is really about the shareholders, and is their really front office is aligned and have the same interest. So they have 67 million invested in the company, and this is something that I do typically like to look at too. I don't really look at the numbers so much, but the percentage. If we go over to Yahoo Finance, they have just about 5%, which may seem small, but if you look at the stock chart, it has gone up quite substantially since it's gone public. So, I mean, a lot of people have already sold out within the company because they wanted to lock in really, really nice gains, because the stock did run all the way up to $60 back in February, when just the whole industry and market was very euphoric. We did have a big crash or correction in March with most stocks in the indices in the stock market. The next point he wanted to make out is that the CEO is actually taking less money per year. They only received $871,000. Now that may seem quite a lot of money, but for people with a similar market capitalization as his company, they earn almost 3 or 4 times that on an annual basis, which is obviously a good sign that they're not ripping off the company. But I would believe that they are very, very heavily based on stock-based compensation. So I think that they would really be inclined for the company to do well over time, and would be very, very well paid if they do well over time, which is something that they obviously would believe in as the CEO, which is a very popular route for CEOs to take. Rather than taking more money per year, they would just take more stock. This is something that Elon Musk has done and has become the richest man on earth by doing so. Grow generation, the last point they wanted to make is just a warning of that this, I think this is just like nitpicking, and they just didn't want to be too bullish on the stock. They say they have 3 warnings, but I think you just have to go to their website and subscribe to them to get the other 2. But he said that because this company isn't buying their stock back, that they may think that this company is overvalued, and are bracing for it to fall further. But I don't really see this as an issue at all, because if you know anything about this company, one, they have a phenomenal balance sheet, and they do have a lot of cash, and they could buy stock back. But I mean, it wouldn't really do anything, considering they're a $1 billion company, just a bit over at $1.2 billion, and they only have $93 million in stock in cash, and they still have, I mean, a little bit of debt compared to their cash. So they'd only have $60 million, or just under, after they paid off all their debt. So that wouldn't really move the stock at all. I think what he's more talking about is individuals within the company buying the stock back. But I think for a lot of them, I think they've already made quite a bit of money and don't really need to. Is just my opinion. I think that if we looked at the stock, it was a single digit stock, or single digits, and it went all the way up to 60. So, I mean, you had at least a 10x if you were invested in this company from the start, and I just don't really see that as a problem. And the bigger picture that I want to point out is that they need a lot of this cash to acquire the companies that I was talking about. Just they always are looking to acquire companies because, I mean, they're only in a certain amount of states currently, and that's only going to expand over time as more states become medical, more states become recreational, and they can move into those states and have a demand for their product. So I just thought that didn't really make any sense to me, and that the rest of the article was very, very bullish on this stock, which I mean, I am as well, and don't really see this 6% move downward warranted at all, which is why I see it as a great buying opportunity to buy the dip and continue to add to your position or initiate your position if you haven't started one yet. If you made it this far into the video, thank you very much for watching. I do appreciate it, and have a great day.